We're going to go hit a few different corners because we're at the start of earnings season here, gentlemen. And thus far, it looks like this is going to be perhaps a little bit more of a difficult earnings season for markets to have a surprise to the upside, because there's quite a deal of, not just expectations are running higher, but as those expectations are running up by the market, given forward-looking PE ratios, we're going into this earnings season with a forward-looking PE ratio of about 20.5 relative to the 5-year average of, and I have that number here, and the 5-year average is 19.1, the 10-year average is 17.7, right? So this is already a rich market, but the companies that are starting to provide expectations are actually looking a little bit more negative. 112 companies have issued quarterly EPS guidance for the first quarter thus far. 79 have issued negative EPS guidance compared to 33 for positive. Why does this matter? Because the 5-year average is for only 58 companies to issue negative guidance, and the 10-year average is for 62. We haven't been this negative since we were in the early part of the 2019 period, when you're coming out of course, late 2018. The economy slows down, the market's going through a bit of tumult. And this goes to show that there actually may be something happening here beneath the surface where, yes, prices are going up, revenues are going up on the top line, but not at the bottom line. Margins are still, while they've expanded, they're kind of plateauing right now. And ultimately, you're looking at a window where the retail and consumer-facing stocks have actually lagged the broader market, which speaks to potential slowdown in consumption here moving forward. Something that popped up to me over last week, one great thing that we do here for the Tasty Live Traders blog, news and insights at the top banner of the website, is on Fridays we put together this report called Off the Charts. 5 things from buy-side or sell-side research that comes through my email inbox, or I see on Twitter, Reddit, what have you, that may be of interest to people. And one of the charts that we highlighted this week was the same-store sales versus customer traffic from the National Restaurant Association, which is now at its lowest level since the pandemic. And the last time it was this low prior to the pandemic was the depths of the global financial crisis. So people are beginning to scale back their expenditures outside of the home. People like to go to restaurants for the experience, of course, and who wants to cook? And you may say this is a DoorDash phenomenon, what have you. But at the end of the day, the fact that people are willing or less willing to spend money outside their homes, and retail stocks have been trailing the broader market. Through the end of last week, the XRT retail ETF was up by 3.25% compared to a 9.07% gain for the S&P 500. You're looking at Eats, the restaurant ETF, was only up by 3.96% in 2024. So retail and restaurants tend to lag the market when the economy begins to roll over. And more importantly, they tend to lead to the downside. They're the first things to go when recession sets in. So I'm not saying that it's happening now. The first quarter was a good one, 2.5% growth likely around there, according to the Atlanta Fed GDP Now growth tracker. But when you look around the corner, the expectations for earnings are high. Companies are actually starting to feel a little bit more negative going to this earnings season. And there's evidence that the consumer is facing some more headwinds and slowing down. So this may be an earnings season where we see a little bit more disappointment around the margins, particularly for those consumer-facing stocks. And that could be a name like a Nordstrom. It could be an Abercrombie and Fitch, which has been a high flyer for a very long time here in recent months. But there may be opportunities in some of those names here moving forward. If you are a bear, that's where I would be looking.
Well, there's no question that.
Well, first of all, let me just say, the bears are on their heels when we're looking at retail stocks to get short. You know what I mean? Like it's.
Oh, that's Mr. Vecchio saying that.
No, I get that, but that's. I mean, like he's looking for.
They're not sexy. They're not sexy names.
That's the point I'm making. Thank you, Chris. I wasn't not the call.
No, I know, but the point I'm making is that's him talking. Like that's not. That doesn't mean that bears aren't thinking the way he's thinking. The last thing as a bear. The last thing I would think about at all is retail stocks. I couldn't care less.
Him trying to help you, and the best he could do is retail stocks, is a bad one.
No, I understand. I mean, it's not, to me.
Not sexy, as Chris put it.
Well, it's not even a question of sexy. It's also a question of tradability. Like, XRT is not tradable.
Right.
And a lot of those retail stocks, I mean, once you get outside of Target and Costco, they're not even tradable. So, for us, there's a lot has to do with tradability as much as anything else. Mm-hmm. And XRT is one of the worst trading, ETFs. But that's not really I don't think that's really the point behind what you're saying. I think the one takeaway I got from listening to what you just said is that I think every earnings season there are a lot of skeptics. I think it is extremely normal and almost healthy to be skeptical of earnings. I think the bigger discussion I think there's two interesting discussions to have around earnings. One is from a selfish point of view, I love the quarterly earnings because it makes things from a tradable side, it makes things, it creates more optionality for traders and more tradable occurrences. So I think from a trader's perspective, I like quarterly earnings. From a business person's perspective of running publicly traded companies, I hate quarterly earnings because they're a complete distraction and they're a waste of resources. And the other problem with quarterly earnings is we've set the system up to essentially create. The other problem with quarterly earnings are that the system is structured now such that you basically have to put out estimates that are easily attained. Like you can't actually create a situation where you say, you know what, if we have a great year next year, we're going to make X. Like you can't say that anymore. What you have to say is essentially, we'll be lucky to make our lowest projection and then beat it, because you don't get
Jack
paid.
Welch, guide lower, beat, guide lower, beat,
Guide lower, beat. Well, it didn't really work for Jack Welch, to be fair. I mean, he was, you know, in hindsight, in
hindsight, yeah.
In hindsight, he was a huge failure.
At the time.
Yeah, huge
At
failure.
the time, though.
No,
at the time, he was lauded for being a genius.
Yeah, I understand, but he was really a failure, and his management style was kind of disastrous for GE and whatever else.
Yeah. Now we know.
Yeah. Now, I guess my point is, though, we're talking about kind of a system issues, and right now, that's what bothers me most about earnings is that companies, you know, that nobody can really tell you, nobody can really kind of think outside the box a little bit. I mean, one of the coolest things about Elon, who I'm not a huge fan of, but who at least was fresh in the respect that he, in the sense that he would come out and say, you know, this is what we're going to do. Like throw some numbers out there. We're going to sell, you know, 1 million cars, or we're going to, you know, we're going to be worth this or something like that. Because nobody else does that. Nobody does that. And I think that's kind of cool.
He has his master plans that he's released every few years.
Yeah, which is
about the path forward and gives you like a beyond the next quarterly earnings point of view of where the company's heading. You can't capture that obviously.
Yeah.
Quarter to quarter.
Yeah, and you can't do it quarter to quarter, and it really, you know, it will mess you up, and it's hard as a company to plan for quarter to quarter because the day you do quarterly earnings, the next day you're doing quarterly earnings again, like you're preparing for the next quarter. And so that's kind of one of the things that always bugs me about earnings. So I take earnings with this crazy grain of salt because for me, they're tradable events and that's it. Like I don't look beyond, like we were talking about this morning, only because Delta has earnings this afternoon. We were talking about Delta Airlines and the last earnings, you know, they missed.
Tomorrow morning, but it's the same.
They missed. They were trading 41, stock went down to under 38. It was, the expected move was 2 points. It went down like 3.5 points. It was a complete disaster. Well, as soon as they washed everybody out after those earnings, hasn't had a downtick since. And that's in the face of rising oil prices, which you would argue would be negative to them.
Negative for the airlines, yeah.
Yeah. So that's why that whole, you know, that's why that earnings, all that earnings stuff, such bullshit, bull crap. And the whole fundamental side to it, to me, is such crap because, you know, Delta's just a perfect example of, that's not really why people, you know, buy the stock. That's not really why people, you know, jump in. It's just, I just don't, I think earnings are nothing more than a tradable vehicle. That's really it. And from a selfish side, like I said, I like the fact that we have quarterly earnings. Like in London, we have earnings twice a year.
Yeah, right.
Which makes more sense for companies. And it puts less pressure on the management team.
Quarterly earnings are hard on a company because you're basically presenting the earnings and then you're compiling.
And you're preparing for the next earnings.
Again. Yeah, right.
Yeah.
Right.
Yeah, it doesn't.
I mean,
it doesn't stop.
Tom, you bring up a good point here. America has many fewer publicly traded companies today than it did, 10, 20, 30 years ago. In fact, relative to where we were about 30 years ago, you're looking about a 40% decline in publicly traded companies because there are companies out there, not to stick with him, but SpaceX and Elon is a good example. Could you imagine if SpaceX was a public company? How would it be making money for the first 5, 10 years of its life? Only recently has it been able to turn a profit, and it needed to be in private markets where it didn't have to worry about how the markets would react on a quarter by quarter basis as it was building out a longer term vision. So there's an increased incentive because the market punishes management teams for the not delivering on the long term vision immediately to stay private, and that's why private markets have flourished and public markets have shrunk in recent years. So I'm absolutely with you. Earnings provide a lot of volatility. I think that until you get a few in a row, like when you look at NVIDIA, is this a one-off report? No, it's actually part of a trend where every single quarter for the past several years has been accelerating growth, accelerating momentum. So you can put together a story there. That's how it provides a big picture. But outside of the day of, do you really learn anything on a quarter by quarter basis unless there's some going concern, a material issue? Not necessarily. But this earnings season, again, it's a high bar going into it, I think is the big takeaway for people. The market is higher valuations going into this earnings season than we have seen in the past. And moving forward, it looks like that there are some signs that the economy may be showing signs of slowing down. Now, granted, we're still running 6 to 7% government deficits, and that's all very positive for GDP. So this could be something where we continue to push forward, limp along. But I guess the big story here, what's happening is whatever's going on with gold and silver in these markets today. I think this is still the most difficult thing in the world to try to fade or call a top on. Anton had a really good study. I know he discussed this with you guys yesterday morning, but it's worth reiterating. He went back and looked over the past few decades worth of data and looked at what happens if you're long the S&P when the IVRs are above 30 or you're long gold when the IVRs are above 30. And something like if you were only long gold when IVRs above 30 over the past 20 years, you would have a total return of north of 75% of the market. Whereas with the S&P 500s, if you stayed long when IVRs were north of 30, your return would have been negative 88% or so. And I think it just goes to show for retail traders out there, being short gold in a rising vol environment is difficult because prices also rise hand in hand. And the technical momentum here is so strong, so very strong right now, that to try to arbitrarily call a top just because vol is high, I think we got to be patient right now. It's very painful out there for people that are trying to do it.
We agree with you, but based on that study, which I thought was really interesting too, but to show you that the short term, right now, we're not facing rising volatility. We're facing contracting volatility
in the market,
and gold is rallying. So I mean, gold has rising volatility, but the market has contracting volatility. So it's kind of flies in the face of that a little bit, I think. But I wasn't sure if he was talking about gold volatility specifically or market volatility. I thought he was talking about market volatility as it applies to gold.
Oh, no, he's talking like, GVZ, like if you were to look at the options.
Okay, well, if you're talking about that, then that's correct, because that as gold volatility is going higher. But it's hard to compare gold volatility and separate it from market volatility.
Yeah, well, it's like just effectively like the statistical backdrop is when you're at these IVR levels, it's typically associated with a market environment where gold's going up. So just keeping that in mind if you're trying to get short here. I mean, that's why I prefer right now, I wouldn't short this, one, but two, if I had to, it's much easier to go through something like short MGC than rather being short the calls, just because there's a lot of convexity in this market still. And who's to say that 2,400 is going to be the stopping point? At 25, we don't know. Right. So I think it's a dangerous place for retail traders trying to short gold or silver right now through the options market.
Oh, the one of the things that you learn probably faster than anything else in this business is those are like meme stocks in disguise, especially silver. Those I've seen some brutal moves over the years in both gold and silver, but there's we've seen brutal moves in other commodities too. Basically, that's the nature of commodities. They are brutal, they're brutal instruments. And when they start going, there is no public other side. The reason for it is in the stock market, if you get a stock that starts to go up, there's natural sellers because people will take profits, right? But in the world of commodities, there really aren't natural sellers. I mean, there's hedgers or stuff like that, but there's not like somebody out there who's sitting there long a bunch of gold is going to go, okay,
Ooh,
yeah,
now's my time.
yeah, that's right. That's why
It's almost like a Bitcoin type.
yeah, it is. It's almost like it. So commodities are trade very differently in those. They trade differently. That's all. There's not a natural sellers.
At least with crypto, it's something as simple as like flipping a switch to turn back on the mining rigs, right? But with literal commodities, yeah, sure, oil companies may see prices going up. Getting a rig operational and back online is not something as simple as flipping a switch, right? So when you see commodity prices go vertical because of whatever perceived supply demand issues there may be out there, they tend to stay unresolved in the short term, and they can get exacerbated, plain and simple. So crude to me at 85. We were talking about this last week, I believe. But crude above 85, funny things happen in the market in recent years when crude's above 85. And so this is like the clear pain point right now. Bonds are sitting on the edge teetering. We have CPI coming out tomorrow. You thought you were going to get a whole let me explain without talking about CPI. Nice try, Tom. But we have CPI tomorrow, and bonds are at this crossroads. I think we are looking at inflation rising for the next several months. It's going to surprise people. And even the Fed. So this idea that the Fed may even be able to cut rates in the first half of this year or even by July, it's worth noting that the market doesn't have a full cut priced in now until September. And that's a tremendous departure from where we were just a few weeks ago. Thus far, equities have weathered the storm. You got to say they've weathered the storm. We've got nowhere in the NASDAQ for a month and a half, but that's with rate cut odds going from 4 to 2. All things considered, that's pretty darn good. But oil above 85 scares me.
I am small, long bonds here, and I am going to.
Me too.
I am going to stay small, long bonds here, just through tomorrow, and we'll see what happens. I'm short premium, long bonds. I'm going to stay that way. I think that's the right play, and who knows?
Very good.
I don't have another opinion. I don't have another opinion on CPI because to me, I don't care. I just hope it creates some juice later on for the trading later on today.